Have you ever wished you could amplify your investment returns, make your capital work harder for you? That, my friends, is the allure of leverage, the potential to turn market whispers into roaring profits. But like any powerful tool, leverage comes with its own set of risks, and one of the most daunting is the dreaded margin call. If you only watch one video today, make sure you watch this one all the way till the end, because in the next few minutes, we're diving deep into the world of margin calls, what they are, how to avoid them, and how to navigate these treacherous waters like seasoned investors. We'll be sharing invaluable insights, real-world examples, and practical strategies to help you master the art of margin trading without falling prey to its pitfalls. So buckle up, grab your notepads, and get ready for a wild ride through the exhilarating and sometimes nerve-wracking world of leveraged investing. And before we get started, don't forget to hit the like button. Let's get 1,000 likes on this one. Share the video and leave your thoughts in the comments. Subscribe to the channel so you don't miss out on the next important financial investing update. Imagine this. You want to buy a stock but you only have half the cash on hand. No problem. You borrow the rest from your broker using your investments as collateral. That's margin trading. But if your investments drop in value, your broker may issue a margin call. This means you must deposit more funds or risk forced liquidation of your assets. Understanding margin calls is vital to managing risk and protecting your capital. A margin call happens when your account's equity falls below the maintenance margin. Your broker may require more funds or securities to cover potential losses. This safety net protects brokers from market volatility and ensures your leveraged positions are secure. Always monitor your account to avoid unexpected margin calls. Margin trading. It can feel like you've got this magic wand, multiplying your gains with every market upswing. But hold on. Remember that wand can swing both ways. What goes up can come down, and with margin those losses, they multiply too. Think of it like this. You buy into a stock using margin, expecting it to soar. Suddenly the market takes a hit. Now that small dip becomes a magnified loss in your margin account, eating away at your initial investment faster than you can say, bear market. And it's not just about the numbers. This amplified risk brings stress, emotional decisions, and potentially bigger losses. Remember, we're in the business of making money, not giving it away. So, before you jump headfirst into the margin pool, ask yourself, am I truly prepared for the downside? Because in the world of margin trading, understanding risk is just as crucial as chasing rewards. Now let's talk about a term that sends shivers down every margin trader's spine. The dreaded margin call. Imagine this. You're sitting at home, enjoying your morning coffee, when, BAM! Your phone buzzes. It's your broker. Your heart skips a beat as you read those two little words, margin call. Suddenly, your relaxed morning turns into a race against time. See, a margin call means your account has fallen below a certain level, and your broker needs you to replenish it. And fast. This means you need to deposit more cash or securities into your account. And I'm not talking about small change, this is serious money we're talking about. It's like the market's way of saying, show me the money. Failing to meet a margin call? Well, that's a whole other can of worms. Your broker can start selling off your assets, sometimes at a loss, to cover the deficit. Not exactly the kind of surprise you want in your financial life. Alright, so you've been hit with a margin call. It's not the end of the world, but it's definitely a wake-up call. First things first, don't panic. Easier said than done, I know. But trust me, a clear head will serve you better than a panicked one. Your broker will usually give you a window, often a few days, to meet the margin call. This means coming up with the funds to bring your account back above the required minimum equity level. Now, how you choose to do that depends on your situation and available resources. You could deposit cash directly into your account, freeing up buying power and satisfying the margin call. Or, you can choose to sell some of your existing holdings, though this might mean realizing a loss on those investments. But there's another option some folks consider, liquidating other assets. This could be selling off stocks in a non-margin account or even dipping into savings. However, this should be approached with caution, carefully weighing the potential consequences. Remember, ignoring a margin call isn't an option. Your broker has the right to liquidate your positions without your consent to cover the shortfall. This can lead to forced sales, potentially at unfavorable prices, further impacting your portfolio, and it doesn't end there. Repeated margin calls can be a red flag, potentially affecting your trading reputation, and even limiting your future access to margin trading. It's like a financial black mark you don't want on your record. So what's the key takeaway here? Understanding the mechanics of a margin call and reacting swiftly and strategically is crucial. It's about minimizing losses, preserving your capital, and learning valuable lessons along the way. Because at the end of the day, margin trading is a powerful tool, but like any tool, it needs to be handled with care, knowledge, and a healthy dose of respect for the risks involved. So, you're staring at a margin call, and you're wondering, is there any way to delay this? Well, the short answer is, it's complicated. While you can't exactly hit the snooze button on a margin call, there are a few things you can try to buy yourself some time. One option is to contact your broker and explain your situation. Now, I'm not talking about spinning some sob story. Be upfront, honest, and present a clear plan for how you intend to meet the margin call. If you have a strong trading history and a good relationship with your broker, they might be willing to give you a short extension. But remember, this is a courtesy, not a right. Don't bank on it happening every time. Another strategy is to deposit additional collateral into your account. This could be in the form of cash or eligible securities. By increasing your collateral, you're essentially showing the broker that you're serious about covering your positions. However, it's crucial to understand that delaying a margin call is not a long-term solution. It's like putting a band-aid on a bullet wound. You're merely postponing the inevitable and potentially making the situation worse. Remember, the longer you wait to address a margin call, the greater the risk of your positions moving further against you. This could lead to a larger deficit and even more pressure to meet the margin requirements. Plus, constantly trying to delay margin calls can damage your credibility with your broker. They may become less likely to offer you flexibility in the future, potentially limiting your trading options. The bottom line is this: while there might be ways to temporarily delay a margin call, the smartest move is to address it head-on. Develop a solid plan, communicate openly with your broker, and take decisive action to protect your investments. Remember, in the world of margin trading, procrastination can be a costly mistake. Margin calls often stem from leverage. Leverage amplifies gains but also magnifies losses. Market volatility and unexpected events can trigger margin calls. Be prepared with a solid risk management strategy. Let's explore how a margin call can unfold. Imagine Sarah, an investor, buys 1,000 shares of Teknova Tech at $50 each using margin. She puts down $25,000, borrowing the rest from her broker. But Tech drops to $30, and her investment is now worth $30,000. Sarah faces a margin call, needing to deposit funds or risk liquidation. This is the harsh reality of margin calls, unexpected and unforgiving. We've all been there, scrolling through pages of seemingly endless terms and conditions, just itching to click accept and get on with our lives. But when it comes to margin accounts, my friends, ignoring the fine print can be a costly mistake. You see, buried within those walls of text are crucial details about your margin account, including margin requirements, interest rates, and, you guessed it, margin call procedures. These details can vary significantly from broker to broker, so it's crucial to understand exactly what you're getting yourself into. Think of it like signing a lease agreement. You wouldn't just sign it without reading it first, would you? Of course not. You'd want to know about things like rent increases, maintenance responsibilities, and what happens if you break the lease. The same principle applies to margin accounts. By carefully reviewing the fine print, you'll gain a clear understanding of your rights and responsibilities as a margin trader, empowering you to make informed decisions and avoid potential pitfalls. Remember, brokers aren't mind readers. They can't know your risk tolerance, your financial situation, or your investment goals. That's why it's crucial to take the time to educate yourself about margin trading and the specific terms of your margin account. Don't be afraid to ask questions. If there's something you don't understand, don't hesitate to reach out to your broker and ask for clarification. After all, it's their job to help you navigate the complexities of the financial markets. Think of it this way: knowledge is power. The more you know about margin trading, the better equipped you'll be to make smart decisions and minimize your risk. So, next time you're tempted to gloss over the fine print, remember this: a few minutes of reading could save you from a world of financial pain down the road. We're talking about staying ahead of the game, folks. In the world of margin trading, knowledge is power, and vigilance is key. Just like a seasoned captain keeps a watchful eye on the horizon, you need to keep your finger on the pulse of your investments. Remember, market conditions can change faster than the wind. What looks like smooth sailing one day can turn into choppy waters the next. That's why it's crucial to stay informed about market trends, economic indicators, and any news that could impact your portfolio. Don't let your guard down. Regularly review your margin account statements. Understand your margin requirements and keep track of your equity levels. Remember, ignorance is not bliss when it comes to margin calls. By staying vigilant and proactive, you're not just reacting to market movements, you're anticipating them. That's how you navigate the waters of margin trading with confidence and avoid those dreaded margin calls. Now, how do you actually stay vigilant? It's all about setting up your radar system. First and foremost, set up price alerts for your margin investments. Think of these as your early warning system, alerting you to significant price movements. Next, make it a habit to monitor your margin account regularly. Don't wait for those monthly statements. Check in at least weekly, if not more frequently, especially during periods of high market volatility. Knowledge is power, my friends. Don't underestimate the power of financial news and analysis. Stay informed about market trends, economic indicators, and any factors that could impact your investments. Remember, knowledge is your best defense against unexpected margin calls. By staying informed and proactive, you're essentially building a safety net around your investments. You're not just hoping for the best, you're prepared for anything that comes your way. That's how you stay ahead of the curve and make those margin calls a distant worry. We've talked about margin calls, how they happen, and the risks involved. Now let's dive into how you can protect yourself. And it all starts with diversifying your portfolio. Remember the old saying, don't put all your eggs in one basket? Well, that applies to investing too. Diversification means spreading your investments across different asset classes like stocks, bonds, real estate, and even things like precious metals. This way, if one investment takes a hit, it doesn't wipe out your entire portfolio. It's about managing risk effectively. Think of it like this. If you invest all your money in one company, and that company goes bankrupt, you lose everything. But if you spread your investments across multiple companies, even if one goes under, you still have the others to cushion the blow. That's the power of diversification. It's about creating a safety net for your investments, ensuring that a single downturn doesn't derail your financial future. It's about playing the long game, folks. Now, diversification doesn't just mean investing in different asset classes. It also means diversifying within those classes. For example, don't just buy stock in one industry. Spread it across different sectors like technology, healthcare, energy, and so on. Remember those margin call causes we talked about? Market volatility is a big one. When you diversify, you're better equipped to handle market ups and downs, because when one sector is down, another might be up, balancing out your portfolio and reducing your risk of a margin call. It's like having a well-balanced breakfast. You wouldn't just eat a bowl of cereal. You'd have some fruit, maybe some eggs, and a good cup of coffee. Diversifying your investments is like giving your portfolio that same well-rounded approach to growth and stability. So remember, diversification is key to mitigating risk and protecting yourself from those dreaded margin calls. It's about weathering the storms in the market and coming out stronger on the other side. Even with the best strategies in place, sometimes unexpected things happen in the market. That's why it's crucial to have a backup plan for handling margin calls. Because remember, hope is not a strategy. First, know your margin call requirements like the back of your hand. Understand how much equity you need to maintain in your account to avoid getting that call. Knowledge is power, and in this case it could save you a lot of stress and financial hardship. Next, have a plan for coming up with the cash to meet a margin call, should you receive one. This could mean having a reserve fund specifically for this purpose, or knowing what assets you could quickly liquidate if needed. But having a backup plan isn't just about the money, it's also about having the right mindset. Receiving a margin call can be stressful, but it's important to stay calm and think rationally. Don't make any rash decisions. If you do get a margin call, contact your broker immediately. They can walk you through your options and help you develop a plan to address the situation. Remember, they're there to help you navigate these choppy waters. Having a backup plan in place not only prepares you financially but also mentally for the possibility of a margin call. This way, if the situation arises, you'll be ready to face it head-on, make informed decisions, and protect your investments. So, be proactive, be prepared, and have that backup plan ready. It's like having an umbrella on a cloudy day. You might not need it, but you'll be glad you have it if the rain starts pouring. There you have it, folks. We've gone through everything you need to know about margin calls, from what they are and how they're triggered to the risks involved and how to avoid them. Remember, margin trading can amplify your gains, but it can also magnify your losses. It's a powerful tool for experienced investors, but it's not for the faint of heart. Before you even think about diving into margin trading, make sure you understand the ins and outs. We talked about diversification, having a backup plan, and most importantly, understanding the risks involved. Knowledge is power, and in the world of investing, that power is in your hands. If you want exclusive stock tips, in-depth analysis, real-time trade alerts, and free investing guides, join the Stocks Galore Patreon today and take your investing game to the next level. Our members there get full in-depth analysis on most of these stocks I mention here. Head over to patreon.com/stocksgalore and become part of our growing community of smart investors. Link is in the description. Don't forget to like this video, share your thoughts and comments below, and subscribe to the channel for more videos like this one. Until next time, remember, invest wisely, stay informed, and keep those profits rolling in.